Good morning. As usual, let's start our run through the week's action by starting with the 2-year note in the States. And this week, everything is basically in the sign of the pound. And I will show you how. 2-year note back to testing bullish levels ahead of FOMC, basically saying that the odds of a hike at the FOMC are just about zero. We agree with that assessment. There is a strong possibility that after FOMC the 2-year note breaks this line and starts trading towards 109.20. Nothing much to say, nothing much different on the dailies. There's a distinct line that we will test around the 109.20 area, but nothing suggests that the market is for the time being going to start looking for a cut. 5-year notes, much the same as the 2-year, slightly more bullish, which is not surprising because the curve keeps on flattening. It's threatening this line, 121.19, which is some sort of a swing line. We will most probably, after the FOMC, go up towards the 122 area. 10-year notes and 30-year notes are the most bullish. The 10-year note has broken through that level and will now undoubtedly at some stage trade towards the 133 area. Now, we are very mindful of the incredible volatility that there will be over the next 7 to 8 trading days. So we have the 9-period EMA here, this thick red line, which is going to be our trailing stop line for our long position in 10-year notes. You can see how it's caught the market extremely well, and basically any close which is going to be below that line we will use as a stop, simply because this is a 300-minute chart which we like employing for a lot of these contracts. We're going to be using this line and the middle of the Bollinger line. So if the market starts breaking down the first and then doesn't just trade between the first and the second, we will certainly use the second as a stop line. Chances are that we will sell some of the position if on a break of this line and be completely out by the break of that line, because the market is extremely overbought. It's as you can see, every time that we've been up here we've had pretty violent reactions of at least 2 or 3 points. So we just don't want to be left holding the baby at these levels. The 30-year note is of course the most bullish, and what can you say? The yield curve keeps on flattening. It's the risk-off trade, which is most likely influenced by the various opinion polls that come out of the UK. Any kind of huge swing towards the Remain campaign is going to make us come and retest that line double quick. So holding positions at these levels, long positions at these levels is well foolhardy. In the 30-year note, we wouldn't do it. We much prefer to be long with the 10-year note because at least we know where our stops are. In the 30-year note, you know, you're taking much more of a gamble. Chances are that this line 167 and 4/30 seconds is going to be retested at some stage. You can see how well it held here. You can definitely try buying it off that line and see what happens. But anyway, that's the run through on the US. no change, flattening of the yield curve, lower yields, especially in the longer end of the curve. Schatz is doing absolutely nothing in Europe. Bobble, because of the contract change, you can't really see it, but it is slightly flattening, lower yields, and the Bund is the one that settled above every single resistance line and now will go and test zero yield without any doubt. And you will see from the European equities why that is. We would not be surprised to see the Bund trading on 166. We are looking for places to short it. We have no reason to short it here. We have no reason even to short it at 166. The time to short the Bund is all wrong. On the other hand, the risk reward of being long is non-existent. So we'll just leave it alone. We have patience, we have plenty of time. There is no rush here. Now let's look at the equities. And let's start from the VIX. This is a chart of the VXX. We were asked, why did we get long of the VIX? Did we think the trend in ES was going to change? Well, yes and no. Did we know that the trend was going to change? No, we didn't. We just thought that the VIX was far too low given what sterling volatility and euro volatility was doing. To us, it's inconceivable that you could have hedging for a huge shock to the system without hedging to have a huge shock in US equities. We think that US equities at the end of the day are going to be impacted at least as much as European equities after the fact. That is because if the dollar were to surge, and there is a considerable possibility that that would be the outcome of a Brexit. We don't think it's going to happen, but if you're hedging for an outcome, you have to hedge for the ultimate outcome of the outcome. So if you are hedging your British pound exposure and therefore hedging your euro exposure and therefore hedging your European equity exposure, you have to say, well, if the outcome is a much higher dollar, the place where it will be ultimately reflected is in US equities. Let's not forget that we've had a huge rally in US equities on the back of a lower dollar. Therefore, if that situation is completely reversed, you will have a complete reversal of the US equity position. Makes sense to us. Therefore, volatility in the 12s or 13s is probably too cheap. What we know is that markets ahead of volatility periods tend to go back to MAs, to moving averages, significant moving averages. So they don't allow anybody a free ride. Well, the 200 period moving average here is around 16.7. That was a huge deviation from 12.95 where we got in. So we thought the risk reward was all on the upside. We happen to be right. UP for us. The big important levels in the VXX are 15.10 and 17.72. We would anticipate that the market will test and fill some of these gaps. So at least mid-15s will be a level that we'll be looking to get out of our position. Now, and that is more or less reflected in the dailies. We would not be surprised to see a move even up to 17, just to spike this lower Bollinger Band, higher Bollinger Band, and get to a 23.6 retracement, which basically actually takes you nothing more to where you were in the month of May, at the beginning of May. So that is not an extreme by any stretch of the imagination. Okay, well, let's look at US cash. Basically, we've been testing the upper range of the Bollinger Bands and of this slightly downsloping trend line. It is not, how shall I put it? It's unreasonable to expect the market to remain at these levels ahead of such an important event as Brexit and such an important volatility spike in the European currencies. Therefore, this move down was not expected but likely, simply because of the move in the VIX. If the VIX goes up significantly, you are bound to get hedging, and therefore you're bound to get people selling. Now, that was the easy part. The difficult part is going to be deciding what to do, how to play it from now on. We think that the 2085 area in SPX is definitely at some stage going to be broken. It's just too easy to buy it off 2085 and then have a free ride up. All the people who are long in this area have to be taken out. Therefore, we think that we will definitely spike at some stage over the next 7 to 8 trading days, which is the time frame for Brexit. We will definitely, on some poll, on some fear, on some stop run, on whatever, run through this 2085 level and possibly go and fill this gap down to 2076 at least. That is our base case. Looking further out, looking on the monthlies, and let's enlarge this slightly, we definitely would not be surprised to have a test of the 5 EMA, which is at 2066, or even to spike down to the middle of the Bollinger Bands around the 2048 area. Wouldn't surprise us in the slightest. What will be much more significant will be how the market reacts there. If by the time of the middle of next week, when the Brexit referendum takes place, we are not lower than those levels, if we are still above 2060, we think these levels are pretty significant. If we are above 2060, then there is a considerable chance that on the positive outcome of the Brexit referendum, i.e. that Remain wins, we have a huge move up. That is the danger. The danger is not the next 30-40 points on the downside, which would be a welcome retracement, but what happens afterwards. Because we still think that the odds are hugely in favor that the UK votes Remain. And if that happens, we foresee the S&P go up to at least the top of wherever the Bollinger Bands are at the time. We would anticipate that to be somewhere around the old highs, around 2032, and we think that that move from these levels around the 2050, 2060 area up to 2132 could be done in basically 2 trading days. So that will be the danger. The danger will be to be short here, not to be short. I mean, we really have no problem with being long volatility or even short the ES or SPX here. we would have a huge problem with being short of it below 2050. It would be perfectly normal for this contract to retrace to around 2046, which is the 23.6 retracement of this whole move up, and then make the next leg higher. That would be absolutely normal. So that is our danger. Around this kind of area, we want to be flat, and then we want to be ready to jump onto the next trend, whether it's up or down. This is reflected in the European markets in spades. So what do we have here in the daily stocks 50? We have a market which has been triangulating and has broken the triangle. Chances are that over the next 7 or 8 days it goes down and fills this gap down to 2,750. So we would not be surprised by a day or two of indecision here and then a break. And then we could have a violent reaction back up to the top of the channel as a relief rally takes place towards 3,200. The same thing is reflected in the DAX. The DAX is slightly more bullish than the stocks, which is not surprising because a Brexit would be a periphery event in Europe as opposed to a, especially German event. It would be much more bearish for the periphery. So we would have we expect a break at some stage and a move down to maybe not as far as this gap, which is 8,900, call it 9,000, but certainly we could have a break that takes out this low 9,500 and comes and tests somewhere around the 9,250 level. That will be the danger area for the DAX. And from there, we could easily see a spike of 10,500 after the referendum. So the trade at the moment is to be slightly short and then absolutely square up somewhere around 9,000, 9,250, 9,300. And wait to jump on the move after Brexit, after the Brexit referendum, which could take it considerably higher. We still favor the upside for all of these contracts after the referendum. Let us now look at the currencies, because that's where the impact, of course, is felt first. This is a weekly chart of sterling. Over the next few days, we really would not be surprised to see a retest of this 139.90, 140 area in sterling. Polls will come and go, something will come out which is bearish, and we would not be surprised to see a retest of this area. That should be the motive why ES breaks the 2083.85 area and goes down and trades in the 2060s. More weakness in the pound. So basically you can trade ES on the back of the British pound. If the pound is going up, ES is going to be stable to higher. If the pound is going down, you will see pressure on volatility and therefore on ES. So that would not surprise us. On the Euro FX side, we think that actually there is much more danger for the euro than there is for the pound in a Brexit vote. And we would not be in the slightest bit surprised if the euro comes down and tests the 110.50, 111 area. On this would be perfectly normal, and the reason, and another, again, a confirmation of the lower trend in ES for the next 7 to 8 trading days. That will neatly turn the stochastics to oversold and then enable a further bounce towards 115 and maybe even spiking 115 after the Brexit referendum. So we think that you can easily be short of the euro and the pound for the next 5 to 7 trading days, naturally picking your spots, and then we will see. This is the one that we have been talking about for quite some time. This is the yen. We still think the yen will at some stage, and possibly over the next 10 days, trade 103.75, and that will be the clue to buy it for a move which is going to be considerable to the upside, at least the 115 area. This is where we've been waiting to buy it for weeks and months now, and we still think that this needs a final wave down, a capitulation, and then we will be getting ready to buy it. Should coincide with a break in ES. It all is beginning to tie in: the euro, the pound, the yen, the stock markets. It's all volatility. It's all beginning to tie in. Let us now look at the valuations and where we are. What do we think is going to happen if the Brexit referendum is remain? Well, we think that we have a very good chance of going and testing the times 17 line in the Blue Angels. That is somewhere around 2140, 2150. What's going to happen if it's a leave vote? Well, unfortunately, we think that we have a very good chance of going a lot lower. The first support will not be until the times 16 line, and that could be reached within a couple of days, and that is just over, that's probably 2010, 2020. But ultimately we think we will go to the times 15 line, which at the moment is around just below 1900. So the risk reward still is all on the downside, but we certainly think that the outcome will be the worse one, i.e. the shorter odds one, which is going to be a spike of the 2130, 2140, 2150 times 17 line up here. The consumer discretionary, nothing to be said. Staples, too expensive. Everybody, this is the flight to defensive. This is the one that's going to get killed if Brexit is a remain vote. Everybody will pile out of it and into something slightly more aggressive. Energy, can't buy it. It'll take quarters for this to normalize. We just can't buy it. And here we have the financials, which are still rubbish. They might not go down huge, but they certainly won't go up huge either. Healthcare still has room to rise, one we are bullish of. Industrials, well, you know, it could easily spike the 500 area, and that'll give us the rise to 2130, 40, 50 in the S&Ps. Information technology, yes, that's got some room to go up. So but you can see that even here on the materials we might have 5-6%, but that's such a small weight in the index. And telecommunication, yes, that can go up slightly. Utilities, no, that's about cooked at the moment, unless we have a huge move in bonds. So that's the answer. Now let's have a look at actually the volatilities of sterling. At the moment, the 143s expiring, so 143 strike expiring on the day after the referendum vote, which is Friday the 24th, are trading at about, that's the calls at just below 4 points and the puts at just above 4 points. So they're trading at 8 points, giving you a break even of what we actually agreed with, which is 135, 151. So basically they're telling you that the market is going to be no lower than 135 on Friday at 4 p.m. on New York time. That we agree with. We think that is a reasonable risk. Why do we think that is a reasonable risk? Well, we are sending you a file which we downloaded from the Bank of England's website, showing you what the maximum volatility on a monthly basis has been for sterling historically, going back 100 years. And you will actually see that even during the worst period, the absolute worst period, which was September of '92, Black Wednesday, trade weighted sterling never fell by more than 6% in a month. That makes sense to us. 135 to us is the worst case that you will see in sterling. And then what you should be constantly looking at over the next few days is this, paddypower.com, which shows you the referendum results. At the moment, still the odds are 2 to 5 against 2 to 1 in favor of exiting. This is sports.labrooks.com, which gives you remain 68%, 32% leave, and finally sports.williamhill.com, which gives you the same odds as Paddy Power, 2 to 5 and 2 to 1. Keep on looking at those. Don't look at the referendum results polls. Those are skewed, those move. Still, the poll of polls, which is the weighted result, has not moved for the past 10 days. There has been no movement whatsoever in that, which is the I guess the weighted average of all polls. So the ones that to look at are the betting sites, because they have been consistently right for the general election, for all referendums, while the polls have been consistently wrong. So don't look at the polls, look at the betting which is taking place in the UK. So the next week is all going to be about the pound. Summing it up, this is the chart of 300 minutes of ES. We would not be surprised by a break of this line, which is the 2082-2085. This is still in June S&P, so you have to adjust it if you're trading September already. And finally, a spike of the moving average, just to get everybody bearish, maybe down to 2060, 2050. How it reacts in this area is going to be very, very, very important to us. If the market is not lower than 2060, 2070 on next Thursday, when the referendum takes place, we will be favoring a quick break higher towards the 2130, 2150 area, and that will be what we'll be playing at The same for the stocks. We think that that market, from a break down 2,700, 2,800, will then have a monster rally to about 3,200, 3,300. So those will be the opportunities. And of course, we will tweet every single thought and every single trade that we do over the next few days. Where do we take profit in the VIX? As we said, we would like to sell, not short it, but get rid of our position somewhere around the 15 and a half, 16 and a half area. It all depends how, how it trades over the next few days. But you will agree with us that this is not exactly bullish. This is a normal retracement within an overall move down. We would not be surprised at a retest of the 200 period moving average, having settled above the 50, 16 and a half ish. That's where we will be looking to get out of VXX, and that should coincide with a breakdown to about 2070 in the S&Ps, 2065, and from there we shall be looking for opportunities to sell volatility and buy contracts. It will be a lot safer to buy the ES rather than sell volatility, because if the results are wrong, volatility could easily spike all the way back up to, I don't know, 24. So good luck to us all. We have our positions. Rien ne va plus, as they say. We will be in touch, and thank you very much for following us.